Hello and welcome to an FXTimes daily market recap. I'm your fundamental market analyst, Nick Nassad. Today is Monday, May 3rd, 2010. The big news over the weekend was that financial ministers from Eurozone countries agreed on a 110 billion euro or $146 billion multi-year aid package for debt-strapped Greece. They're betting that this large aid package will be enough to inoculate the rest of the region from contagion. The ECB also said that it would suspend indefinitely the minimum credit rating threshold for collateral eligibility requirements for Greek sovereign debt, a move that only 3 months ago they said that they would not take. Finance ministers approved the unprecedented bailout on Sunday as we had the Greece country fiscal crisis spreading to other periphery nations like Portugal and Spain. During the announcement of the meeting, however, they refused to say how they would help other indebted nations if that need arose, calling Greece a special case. We now have to see if legislators from around the Eurozone countries will delay disbursement of the aid to Greece. After a rally in the euro-dollar pair from midweek till the end of the week in today's trading, after we entered slightly higher at the 1.3359 area to start today's trading, we slid in the Asian session and we consolidated below 1.3250, which was also our 100 period moving average in a 1 hour chart. So even though the financial ministers have agreed to a deal, it's now on to the political arena to see if it could be approved. Now, in New York trading, we saw the euro-dollar swing lower as we had strong U.S. fundamental data come out, which helped to support the greenback against the euro. The positive U.S. data made a sharp contrast to worries about the administration of an unprecedented bailout for Greece. We found the secondary support at the 1.3150 level. If we plot a Fibonacci retracement of our rally from the middle of last week till the end of last week, we could see that today's consolidation happened around the 50% retracement area, while the support at the end of the day in New York trading came at around 78.6%. Before we take a look at more currency pairs, let's take a look at that US data. Let's start with the manufacturing sector, where the ISM Manufacturing Index posted its strongest reading since July of 2004 as it registered a 60.4 reading for April. New orders, production, and employment sub-indexes all saw strong increases in April, and the extraordinary strength in new orders bodes well for the recovery in the manufacturing sector and that we should see continuing growth from the sector. The employment index, meanwhile, means that hiring in the sector should continue to pick up as well. The manufacturing sector has been spearheading the overall U.S. recovery, and this is a positive report showing that to begin the second quarter, we're seeing a continued expansion of activity. Turning to a second report, we saw that personal spending in the U.S. rose by 0.6% in the month of March as consumers were confident enough to open up their wallets to end the first quarter. They did so even as incomes rose 0.3%, which meant that they had to draw down their savings, with the saving rate falling to 2.7%, which is the lowest since September of 2008. In our first quarter GDP data that came out last Friday, personal consumption was up 3.6% from the fourth quarter's 1.6%. And with consumer spending making up 70% of GDP, this is a positive sign that a resilient consumer will be part of the way forward in supporting the recovery. This outcome that a higher consumer spending was not guaranteed coming out of the recession, as the concern had been that consumers would retrench and work on paying down their debts instead of spending. In a sign of this increased consumer spending, Ford's U.S. domestic vehicle sales jumped by more than 20% for a fifth consecutive month. In a third report, we saw construction spending for the month of March rise 0.2%, which surprised forecasts on the upside as forecasts had called for a 0.5% decline. It was the first increase in construction spending in the last 6 months. However, in a downside to the report, we did see February's reading revised down to show a larger than expected decline of 2.1% from the originally reported 1.3% decline. Before a small gain in employment during March, the construction industry was shedding an average of 72,000 net jobs per month during the prior 12 months, so this at least is a positive sign that spending could be turning the corner. Now from the internal figures, private construction spending actually decreased by 0.9%, and it was the public sector which expanded by 2.3%, which helped the overall figure turn positive. Going back to the euro-dollar quickly, we see that following that positive data, especially the manufacturing report, we had a second round of gains for the greenback against the euro. If we turn to the dollar-yen pair and zoom in, We see that we had already been increasing in this pair in favor of the greenback, and in New York trading we moved above this 94.50 level, which was our resistance in Friday's trading. Zooming the pair out, that comes very close to testing our highs back here on April 5th, around just where we met our resistance today, 94.80. A move above this level would be a very positive sign for the dollar against the yen. The yen was weaker against most of its other currencies, including the pound, and even giving up its earlier gains against the euro. In addition to the positive fundamental news, we also had a strong surge in U.S. equities, which helped us give a sense of risk appetite to the New York session. The Dow Jones Index, for instance, was up 150 points as of 2 p.m. Eastern, and the Nasdaq and S&P were both up 1.5 and 1.4% respectively. U.S. stocks climbed at the open as UAL and Continental agreed to join forces in the airline industry. We also had the round of economic data providing further evidence of a continuing recovery. Taking a look at one of our risk sentiment sensitive pairs, the US dollar Canadian dollar, we see that following a move in favor of the greenback on Friday on the back of risk aversion, in today's trading we had the Canadian dollar gain against the greenback, with the US dollar Canadian dollar pair falling back to 1.01 area. In addition to higher equities, we had commodity prices rising, especially oil, which helps the loonie. Coming into this week, we were testing our resistance from last week around 1.02, and we could see that that was our third attempt to move to that level in the past couple of weeks. Now we do come close to testing the 100 period and 50 period moving averages, and if we draw a Fibonacci retrace of our rally from Friday in this pair, we see that today's support also comes around the 38.2% retracement. So it's so far a shallow retracement of this rally. We also have this upward sloping support trend line to keep an eye on if we do move further down in the next trading session. The Australian and New Zealand dollars were up slightly in today's trading as gold prices pushed higher, but with the Aussie, there was a couple of things to keep an eye on. First, we did have China's central bank on Sunday announced that it was ordering banks to set aside more of their deposits on reserve for the third time this year, a move that tries to put the brakes on China's economy as well as crack down on surging domestic property prices. China is very important to Australia's export sector, and so that the news from China could dent the commodity-backed Australian dollar. We also do have an RBA meeting coming up in the upcoming Asian session, and with expectations that we will get another 25 basis point hike, that did help the Aussie to rally today. So overall we were up slightly despite the news coming from China. Zooming this pair out, we did have this downward sloping resistance trend line that we are testing again with today's high and also our 50 period moving average, though we did manage to move above that resistance level on Friday's trading. So if we broke it once, there's a much better chance that we could move above this level again, and if we do have a RBA interest rate increase, that could give this pair the momentum it needs to rally upward. However, the 0.9350 level is going to be a very important level of resistance, and we'll just see if the market has enough momentum to actually push above it if we rally. There are some indications that the interest rate hikes by the RBA already are filtering down into the housing and consumer spending sectors and are starting to curb growth somewhat. If we have actual strong attempt by China to cool its economy as well, that'll put downward pressure on the Aussie going forward. However, on the positive side, if we switch to our gold chart, we see that gold prices continue to rally as we had a increase in risk aversion over the past few weeks as a result of Greece, and gold has been demanded as a safe haven asset. So that's the main news for today. Let's take a look at the upcoming fundamental docket. Tonight at 6:45, New Zealand posts its quarterly labor cost index, and overnight at 12:30 we get the aforementioned RBA interest rate decision. Also overnight we get data from Germany on retail sales, the UK on its manufacturing sector and net consumer lending, and producer prices from the Eurozone. Tomorrow in the US at 10 a.m. we have two reports, the pending home sales index as well as factory orders. And that will wrap up today's daily recap. For more news, videos, and analysis, please visit our site fxtimes.com. I want to thank you for watching and wish you good trading.